This morning's hearing is the second installment in a series of hearings focused on regulatory relief for community financial institutions. Last week we heard from a panel of credit union representatives. Today we will hear from community bankers. These hearings are an opportunity for our members to further examine proposals for regulatory relief from community financial institutions. The challenges facing community banks across this nation are not new. Every time our nation experiences a financial crisis, Congress responds with new regulations and, in some cases, new agencies. Rather than identifying outdated, unnecessary, or overly burdensome regulations while formulating these new policies, too often the response is just to pile new regulations on top of the old. We are now seeing this as the Dodd-Frank Act is implemented by the federal regulatory agencies.
If our community banks can't get dollars out the door, then it's not just the banks that suffer, it's the family that's trying to buy a home. It's the entrepreneur who's trying to start or expand their business. It's the farmer who's trying to purchase a new piece of equipment that suffers. It's our local economies that these community banks serve that suffer when they're not well functioning.
All we need to look at is the consolidation of these banks for the past several years. Even the FDIC's community banking study found that the number of federally insured banks decreased from nearly 18,000 in 1984 to 7,000 in 2011.
Congress needs to do more to relieve community financial institutions from the regulatory burdens that they're facing. And I believe that this recognition has been borne out from hearings like this and from meetings like the meetings that I'm having and other members of Congress across the country are having with their community bankers in their districts.
I am frequently told by my community bankers that they feel like they are no longer working for their communities, but instead that they are working for the regulators. I regularly hear that overregulation has effectively prohibited reputational, relationship, and character-based lending, which deprives reputable entrepreneurs and small businesses of the ability to access the capital needed to create jobs. Why do we continue to suffer from persistent high unemployment in this country? Why is this the most anemic economic recovery since the Great Depression? I submit that this is one of the reasons.
As we adjust to this new landscape, unintended consequences will surely arise throughout the process. As we go forward, helping customers and small businesses meet their financial needs, regulators should consider not only the one-time cost and the annual cost of compliance, but also the impact on innovation, new product development, and the overall diversion of resources from meeting customer needs.
Many actions since the financial crisis have hurt, not helped, community banks. For example, at the same time that banks were trying to serve their local communities, new rules meant more compliance officers and fewer customer-facing employees. Just when regulators want to see banks grow, they raise capital standards and now are proposing new Basel III standards that will surely force banks of all sizes, but particularly small banks, to reduce lending.